So that's $11 billion of loans that are potentially in default at RBC, and they are decreasing their loan loss provisions. Two Canadian banks look incredibly risky as delinquencies skyrocket. So let's get into what is going on here, because we could have the potential for a banking crisis. And when we get into the numbers here, you will realize why. So we went through this chart, which came out a couple of weeks ago, but nobody noticed this, including myself. I was actually thinking about this one evening, and I came in and just wrote down on a piece of paper. But when you look into the numbers here, it's truly shocking of what is going on with two Canadian banks. You've got delinquency rates at 0.31% at RBC. And if you look at CIBC, you've got delinquency rates for Canada at around 0.38%. And this is mortgage delinquencies. So in terms of delinquencies, these are actually the lowest. Now, if we actually get into the data of what's going on with other loans, you'll see how that's much higher, and then we can take an average. So skyrocketing number of people in Ontario are defaulting on housing and other bills. And this comes from Equifax. And what we really want to know here is Canada as a whole, the default rate right now, Q2 2025, is 1.6%. And that's up 14.31% from a year earlier. So let's say you then take an average from that, and then you go and look at their loan book. Now, RBC's loan book is growing, and they're also decreasing their loan loss provisions. So I know it sounds insane considering all the risks in the economy, but that's what they're doing, and we'll get into the data on that. So their loan book is 1.1 trillion. As we covered last week, if you want to see which banks their loan books are growing and decreasing, I will link that video at the end of this one. So 1.1 trillion in loans at RBC, and what are they doing to their credit loss provisions? They're going down. And the same thing is going on at CIBC as well. And we only have the delinquency data for these two banks at the moment. So you've got $881 million in loan loss provisions at RBC and 559 million loan loss provisions at CIBC right now, as you can see on this chart that was generated by Warren AI. If you're interested in Investing Pro, there's a link in the description, by the way. It's an affiliate link. But anyways, you take a look at this chart here, you can see what's going on. It's going down. Meanwhile, loans at both these banks are absolutely exploding upwards. They're the highest growth of the big five, RBC and CIBC. And you might think, well, this is fantastic for earnings. Well, the hilarious thing is when you dig into who actually owns the Royal Bank, it's mostly retail individual investors. So, you know, you've got a lot of retail investors that have ownership stakes in this bank. So it's in their interest to know what's going on with the risks here. And what you have to look at is, okay, as we established there, you've got $1.1 trillion in terms of loans. And at CIBC, you've got 622 billion. And if we go back to that chart again, you have the 881 million in loan loss provisions, 559 million in loan loss provisions at CIBC. And if we go to the percentage calculator, you can see the easy math here is that 1% of 1.1 trillion, that would be $11 billion. So that's $11 billion of loans that are potentially in default at RBC, and they are decreasing their loan loss provisions. And that number is rising, and it's actually laggy as well, because you're talking 3 months in the past when it comes to this reported data. And we know that the delinquencies, the power of sales, they are skyrocketing right now. And then obviously at CIBC, that's going to be 6.22 billion. And if you want to know what the percentage jump in the loan loss provisions would have to be to have them at par with the number of loans that are in default, that would be over 1,000% jump in the loan loss provisions. And like I said, the loans in default right now, that is just going up. And it's not just RBC and CIBC, of course. This is happening at all the banks. And in fact, a lot of the banks, like Laurentian Bank, are going to have a higher number than that. And their numbers are going to look even more ridiculous. But we just don't have the data for them. We only have the data for CIBC and RBC. And then if you look at the earnings for RBC last quarter, their earnings were net income of 5.5 billion for the quarter, right? So if you look at that, that means that the amount of loans in default right now are pretty much double what they just earned in the last quarter. And obviously these numbers, they're not actually that high, but when you're looking at numbers and leverage ratios like the Canadian banks, you can quickly have something like that turn into a crisis and blow up on a bank's balance sheet, which leads to their earnings tanking and the stock going with it. And obviously these delinquency rates, they're just going to continually increase. And the reason why a lot of these mortgage delinquencies, especially, which account for the Canadian banks 60 to 70% of their loan book, are going to continue to go up is because all the loans that were created over the past 5 to 10 years were people buying homes and they're underwater insane amounts. This chart comes from John Flynn and you can see that it's just insane. Some of these places are down near 30%. But even if you look at Edmonton, down 1.5% from peak, you know, still when you have to pay 2 to 5% when you're selling a house, you need to be up at least 5% in order to come out with any money. And do people have the money in order to actually take these massive losses? Absolutely not. And you're just seeing that bigger and bigger losses are becoming more common. This comes from Shazzy, a Hamilton detached bought in 2023 for $630,000, just sold for $260,000. That's a 60% collapse below its 2015 price, and it was featured in Saga. And you know, it's just crazy when you think about those numbers, because when you look at these losses, especially in Ontario, you realize that a lot of these mortgages are built on assets where the values are down significantly. So there is incredible risk that a lot of people just aren't seeing and aren't looking at, because mainstream economists, they're just not taught to look at these things. They're not taught to be right because they don't have their money on the line. And there's a lot of biases because of the advertising space as well. And what's crazy as well is that RBC is also warning about the housing market and the condo market, how it's as bad as the financial crisis. But then at the same time, you look at what they're doing with loan loss provisions and you look at what they're doing in terms of growing their loan book, it just does not make any sense. I think the fact is these banks don't care because they know that ultimately, if anything bad happens, the government is going to bail them out. And then I also want to point to this article as well. Debt is catching up with Canadians. And just listen to this. They are now reckoning with the consequences of going all in on real estate during the early 2020s boom. Crushed credit ratings, legal action, consumer proposals, power of sale, and bankruptcy. Do any of those options sound good for a bank? Absolutely not. None of them do. In fact, in most cases, they're going to be losing money going after people who don't have the money, or those people declaring bankruptcy, consumer proposals, things like that. And these assets just aren't worth what the loans have outstanding. And that's the main thing. We are seeing the fear of missing out giving way to the fear of losing everything. And what is funny about this is I remember in 2021, the Globe and Mail were publishing lots of articles which were showing homes which were selling over asking price. And obviously that just gets more and more people into that fear of missing out type mentality that you get in a mania. And that's what was reinforcing it as well. Canadian small businesses see it in their bottom lines. Last week, Equifax Canada reported that 286,000 businesses in this country missed a loan payment last quarter. So again, again, that number of 1% could be a lot higher. And, you've just got to see the incredible risk. The banks are saying, you know what, we're just going to take down our loan loss provisions, put more money into our earnings. Meanwhile, their loan books are increasing in size, so they should actually be amping up their loan loss provisions. They're doing the opposite of that. I don't know who's in charge of risk, but they should be fired. And if they want to employ me in the Cayman Islands for a decent salary, then yeah, drop me a line. But I don't think that is going to be the case, because they don't want people like me. They want people who've been to Ivy League schools and have an education in broken economics. And that's just the reality. I don't think that is going to end well when you're going into a recession. Canada is in a recession, but the reality is when they realize that Canada is in a recession and the broken economists come out and say it, then they're soon going to be themselves about what is going on. Canada is in recession, and for a lot of people who've lost their job, they're in the depression and they realize how bad it is. Check out this video from last week where I go over the growth in the loan books. There are some crazy risks that are hidden in there. And if you want to check out Investing Pro, which I use a lot in the videos and I use for my own portfolio, there's an affiliate link in the description. Anyways, thank you so much for watching. I will see you in the next one. Take care.